Alrighty, we are back. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn, Focus Compounding, bringing you another YouTube video today. Yesterday, I had gone over a checklist of things to go over when you are in the 10K, within the 10K. And in today's video, I'm going to be going over a checklist for going beyond a 10K. And this is also going to be in the show notes, so make sure you check it out. We give it out on focuscompounding.com, but I'm happy to share with it and go with it with you here today. This is going to be a new playlist, so I will have a checklist within a 10K, and we're going to go through all of that and go through a bunch of videos. And then this is going to be a checklist for going beyond a 10K. So really just things to think about that may not show up in the filings, but nonetheless is very important. If you've watched my videos that I did in front of a whiteboard, I went over this, but I'm going to go over it again today and use this going forward just because I have a lot of new ideas that I want to use to demonstrate all this. But the way that this checklist is laid out is we have overview, durability, moat, quality, capital allocation, value, growth, misjudgment, conclusion, appraisal. And the way that Geoff created this is if you can't figure out the overview of the business, well, you certainly should not care about the durability. If you can't come up with the overview and find out what's durable about the business, well, then you definitely don't care about the moat or the quality. So it's really a good checklist to do in order. And if you can't, for example, find out the overview, the durability, the moat, and the quality, well, you certainly won't care about the capital allocation. So that's Geoff purposely created it like that. He used this format when he was writing for Singular Diligence, and I think it's a good format for people to even follow for themselves if they're going to write up a stock idea. So the first thing is overview. So give an overview of the business. What is the business? What units make it up? What products do the business have? Who are the customers? You could also add in there like why do they buy it? Where do they operate geographically? Is there some sort of recent events like a spinoff? Is the stock trading close to its 52-week low? Basically, try to find out why are we looking at this. If you can't answer this question, then you should probably put it in the too hard pile and move on to the next company. Try to think about or find out who's their biggest customer, who are their biggest suppliers, what is their biggest product, what are they basically known for. So when you think of Apple, for example, you probably think of iPhones, you probably think of iPads and laptops. So if you can't answer these questions and basically come to, I guess, an agreement on deciding why are you basically looking at this company, put it into a hard pile. If you can't give a overview of the business and what they do and how they make money, put it into a hard pile. I remember when Geoff and I were going over Graph Tech and I read a write-up that somebody actually wrote up on Focus Compounding. I literally was like, these Coke needles and all this technology and everything, I can't even picture it in my brain, and I'm not even excited to learn about it. So it goes in my too hard pile. And guess what? That's okay. But I think that's really important. And of course, if you can't answer these questions, just move on. That's okay. So the next one we're going to be going over is durability. So you want to think about, is a product durable? Think about why it's durable. Have the companies always existed? Have there been changes and challenges before? What was that based on? Basically, why did they come out of that? How were they able to come out of that? Why is the business going to continue in the future? Is it a fad? So think about, does it have some sort of need in our society? If you think about Snickers, for example, Snickers has been one of the most popular candy bars for the past century. And you could bet with pretty high certainty that for the next century, Snickers are still going to be popular. People enjoy chocolate. You could think about that with Wrigley chewing gum, Coca-Cola, and companies like that. So really think about, is it a durable business? Why is it a durable business? Is this a fad? Is this a Beanie Baby? Is this a BlackBerry? Is this company able to continue to innovate and stay relevant? If you think about Apple, and I always use Apple because everyone knows Apple, they have basically reinvented or built off of their current ecosystem a bunch of times. If you think about the watch game, if you think about their laptops, if you think about their iPads, if you think about their iPhones, they have continued to innovate and build on their ecosystem. Next item on the list that we'll go through is moat. So think about, does a company have a moat and what would it be? We've talked about and written about Hamilton Beach Brands a lot. Do they outsource their business to China? Can they outsource it? Can other people replicate it? Where does this source of moat comes from? Is it a competitive advantage? A lot of people think that if a company has a high return on invested capital or return on capital, it has a deep and wide moat. But the way that Geoff thinks about moat is the intangible quality of the business that allows it to have a high return on invested capital. So some things that you could go over, high switching costs. You think about like credit cards, banks, people very rarely switch those, phone providers. It's just a pain and a hassle to make the change. Patents, I think that's pretty self-explanatory. If you are legally protected, that is a huge source of a moat. Contracts, long-term contracts, things that, are going to at least protect you from competition coming in and taking your business. Does the company have extreme network effects? If you think about eBay, for example, buyers go to eBay because they know there's a lot of sellers, and sellers go to eBay because they know there's a lot of buyers. Does the company have shelf space? If you've read up on Hostess Brands and Twinkie, one of the things that the private equity firm that took them public again did was they improved their shelf space and gave it a longer shelf space. Does the business have a brand that's important? Think about like Nike, think about Apple, think about Coca-Cola. You're not going to have an off-brand Coca-Cola if you can drink the true Coca-Cola yourself. Does the company have economies of scale or some sort of logistical advantage? Is the business in the right spot? Location, location, location. If you think about Starbucks, for example, every single Starbucks is usually in a pretty populated area. You don't go in the middle of nowhere and find a Starbucks. So Starbucks, I would say, is pretty good about where they place their restaurants. Is there some sort of regulatory advantage? You think about VRSN, VeriSign, the domain registry for .com and .net. They are legally allowed to be the sole provider of .com and .net. I don't know when the contract ends, probably a couple of years, but they've been doing it, I think, since like the early 2000s. So that's a huge source of moat for them. Does the business have high barriers to entry? Basically, would it cost somebody a ton of money to replicate what a company is doing? Is there some sort of technical skill or reputation? For example, Apple can't trust a company that's a startup, but they can trust a company like an Intel that's been around for a while and is a proven company. Basically move down the list and talk about return on capital. How do they get this return on capital? Feel free to break it down. Where does it come from? One of the things that Geoff always wants to figure out is the customer retention rate. Sometimes the company will tell you what they estimate it is, or you could just do your own scuttlebutt to try to get a good feel for it. Is there anywhere you could find reviews by the customers? I'll go through this in a bit. I think it's a really good source for going beyond a 10K. Can you get anything that's ranked in the industry, like customer service awards, customer satisfaction surveys? We always check Glassdoor for the culture of the company. I think that's very important. Basically, you really want to find out what the customers think of the product, and a good way to do that is by reading reviews. You can read reviews on Amazon, unboxings, etc., all sorts of stuff like that. A really good source to go through the quality of a business is read Phil Fisher's 15-point checklist for quality and growth. I actually did a video on this a while ago. I'll probably do a more updated one, but that's a really good source for going through the quality of a company. Next on the list is capital allocation. Obviously, that's very important. You want to invest in a management that has a proven track record of capital allocation, especially if you invest the way that Geoff and I do. And a good way to figure that all out is go through the history of dividends, stock buybacks, stock issuance. We always do the CAGR in the number of shares outstanding. So really you want to see, has shares been diluting over time, or have they been getting smaller because management is buying back their stock? It's all good information to know. As I said in my last video, obviously investing is all about the future, but you could just get a gauge of the future by studying the past and use that to your advantage. You could see how management's bread is buttered. Are they compensated via options, restricted stock, bonuses? What do the targets make up? Is it based on return on equity or return on capital of the company? Is it based on market cap? How much stock does management actually own? And is that significant in regards to their salary? This is all great information to know just to really see how they're compensated, because incentives do drive human behavior. And if you believe that, then obviously capital allocation is an incredibly important aspect of the business. A lot of times companies have career CEOs that rise through the ranks, and they may not be as familiar with capital allocation. So it's just really good to judge their capital allocation abilities based on what they've done in the past. Figure out what they've done with free cash flow historically. You could get that from the cash flow statements. We really recommend reading transcripts and reading proxies and just pretty much everything you can to try to get all the information possible. You could screen for companies that buy back their stock a lot. That's a really good place, which is what Munger likes to talk about, these companies that just eat up their market cap and buy back a ton of stock. You could also go and see the timing of them buying back their stock. Do they just do it like on an automatic basis, or do they buy back their stock when the stock is cheap? That's just all really good information to know. Next is value. And again, like I said, if you can't figure out the capital allocation, the quality, the moat, the durability, you're certainly not going to care about the value. But really go through what's the PE, what's the EV to EBITDA, how does that compare to other companies. In the past checklist that we used, we said that we use 5 peers, and then really compare it, right? Is GE cheaper than Ford? And if so, does that make sense? Why does that make sense? Talk about what management is guiding. A good thing to see is, was there ever an offer that was refused or that fell apart? You could read the SEC filings on that acquisition. This is all great information that you could use to your advantage. So get really good at Googling. As we talked about in the last video, what prices do acquisitions happen at in the industry? That could be a very good source for potential value. Next, we can move on to growth. It's good to break down growth. Let's say they can grow by 5% a year. How much of that is same store sales? How much of that is price increases? How many active users? Really just get down to the nitty gritty of what's driving the growth. Is it from them raising their prices? Is it from them getting more volume? That's all information that you want to know. If you read the MD&A, sometimes you have to sort of read between the lines, but you could always pretty much figure it out. And then break it down by geography, right? Are they growing a lot in Mexico but not in the United States? Does that make sense? A company we've talked about a lot is Psychomedics. They grow a lot in the United States, and they tried to grow in Brazil, but their Brazilian business is pretty much cut off from now on. So that's just good information that you'd want to know. What's their market share? Can they continue to gain market share? And then it's good to compare that to other companies, right? Because I think it just keeps things realistic. Can cheesecake be as popular as Chili's and have as many restaurants around the world? Probably not, because they're bigger. The capital cost to start up with cheesecake is a lot different than Chili's. So I think it really just keeps the big picture in mind. And then always think in terms of nominal GDP, population growth, and inflation, and try to figure out how much have real sales grown. The next item on the list is misjudgment. This is something that is good to do to really get the consensus and see what other people think about the stock. What are other people seeing on the short part of it? I love reading short reports. I think if you study short selling, it actually will only make you a better long-only investor. What can't we predict? That's important. If it's important and you can't predict it, forget about it. But if it's not important and it is knowable, we'll proceed on forward. Geoff always recommends checking the short thesis. A good place to do this is really just Googling around on the internet. People do make fun of Seeking Alpha, but that is the consensus. So maybe it's a good spot to start to go read some other write-ups. Go into Value Investors Club, Corner of Berkshire, type in the hashtag on Twitter, really just see what the market thinks about the stock. And before we come to the appraisal, we really just want to bring everything home with a conclusion. And that's pretty much taking everything above and just giving a little mini analysis of it. Basically, it's the elevator pitch. Constantly asking why, and then bringing the answers home. Let's talk in 3 points. How safe is the company? How high quality is the business? And then how cheap is it? And of course, we put those in that order on purpose. Safe means debt to EBITDA. We like companies, obviously, that aren't too levered. The FZ score, we talked about that a little bit in the last video. That just is a bankruptcy indicator. We'll definitely go through that in Excel. Years of positive earnings. We usually like to see 10 years of positive earnings. Cash flow, is it positive? Free cash flow, do they generate it? Is there a variance in the margin? So really bringing up the min, the median, the max, the coefficient variation, the standard deviation of the margins. If the company has bonds outstanding, check the ratings on those bonds through Moody's. You could also read the report, check the interest rate on the debt. Talking about quality, what's the long-term CAGR of the stock? We've done that in the last video with the stock chart. Is it high enough? If you think the markets over time do 8%, well, you're probably not going to want to invest in a company if the stock is only done, for example, and it's the same business, less than that, or maybe even 9 or 10%. Is there that much of an outperformance there? Is it a good industry? Is it a durable industry? Is it going to be around for a while? Does it have a very long runway? You could do a KR on the other stocks in the industry. Think about, is it a cyclical industry? Are these companies, products, services of the company that you are looking at as good as the competitors? If it's better, why is that? This is just all stuff that you want to think about. And then cheap, is it cheap on an EBITDA or EBITDA sales basis? You could do a private owner value analysis. Basically, think about what a rational private buyer would pay if they were offered the business in its entirety. And then the last one is the appraisal, which of course this is last on the list on purpose. The appraisal should be the simplest part of the investment, in my opinion. If you think it's a great business and it's trading at 10 times earnings and you think it could be worth 15 times earnings or 20 times earnings, well, that's something that you want to analyze and go over. The thing that I love most about this list is the part down here, which again, you guys will all get access to this. It's being the journalist and really going beyond the 10K to learn as much as you can about the company. Some things that we recommend is go to the proxy statement and find out who owns stock in the company, Google all their names and learn about who they are, and maybe their history when it comes to business. Do they sit on other boards? Are they investors themselves? Do they have a lot of their own personal money tied up in the business? One thing that Geoff and I always do if we're looking at a company is get satellite images of their headquarters, and if they have any properties, look at that as well. A, to make sure that it actually exists, and B, just to get a sense of why they would put the headquarters where it's at. Whenever I see a company that is headquartered in Dallas, for example, or Plano, Texas specifically, which there's a lot of companies that actually come across that are headquartered here. I just know that that area is a pretty well-populated area for businesses to have their HQ. Glassdoor, we already went over that, but it's something that I love to do. Try to get a sense of the culture in the business. Are the employees happy? Do the employees talk bad about management? You'd be surprised what you could read on here. Just really get a feel for the culture, and then really just look for news on the business, Googling around. So type in the company and go to news and really just search around, become a good Googler and try to find out as much information as you can about the business. A lot of these companies are probably pretty important in their communities. So it's just really good to Google around and just to see what articles you could find. The CEOs, for example, I'm sure there's been some times where they comment on certain things, or if they've been on the news. It's just good stuff to know. One thing we always do is look at the Better Business Bureau as well, just to get a feel for that. And then one thing I like to do is see what the customers say about the business. So read the Yelp reviews, read the TripAdvisor reviews. Obviously, customers are the livelihood of every single company. So if they're very happy with the business is offering, well, that's just good information to know. So I can't wait to go through all of this with you guys. I'm really excited. I'm loving the engagement that we're getting on YouTube, and I really appreciate everybody that leaves a thumbs up, comments, and shares the content. I'm really going to pump out as much content as I possibly can. Like I have said, this is going to be in the show notes, so make sure you check it out. Feel free to leave a comment down below if there's anything that you would like me to go over in these videos. I want to thank everybody so much for tuning in with me. Hit that subscribe button, thumbs this video up, and I will see you in the next video.